So far in this course, we've spent most of our time talking about stocks and bonds, and that's intentional because for most investors, stocks and bonds form the foundation of a successful investment plan. But if you've spent any time reading financial news, watching YouTube videos, or scrolling through social media, you've probably heard people talking about other investments: real estate, gold, silver, cryptocurrency, commodities, collectibles, and maybe even a few things you've never heard of before. So today, let's take a quick tour of some of these alternative asset classes. But before we begin, I want you to remember one important principle. Alternative investments should usually complement a solid financial plan. They shouldn't replace one. Think of your investment portfolio like building a house. Stocks and bonds are the foundation, the concrete, the framing, the structure that holds everything together. Alternative investments are more like the furniture and decorations. They may add value. They may make things more interesting, but they don't replace the foundation. Let's start with real estate. Many people are attracted to real estate because it's tangible. You can see it, touch it, walk through it. You might own a rental property, commercial property, or even vacant land. Real estate can generate income and may appreciate in value over time. However, owning property directly also comes with responsibilities: maintenance, repairs, tenants, insurance, property taxes, and sometimes direct property ownership comes with unexpected headaches. For investors who want real estate exposure without owning buildings directly, there are REITs. REIT stands for Real Estate Investment Trust. Think of a REIT as a mutual fund or ETF that owns real estate. It allows investors to participate in the real estate market through a regular brokerage account. For many people, REITs provide a simpler and more diversified way to invest in real estate. Next, let's talk about commodities. Commodities include things like oil, natural gas, corn, wheat, coffee, copper. Unlike stocks and bonds, commodities generally don't produce income. Their value depends largely on supply and demand. Commodity prices can be extremely volatile. Most investors who want commodity exposure do so through funds rather than purchasing commodities directly. After all, very few people want a barrel of oil delivered to their driveway. Now let's discuss precious metals. Gold and silver have been used as stores of value for thousands of years. Many investors view precious metals as a potential hedge against uncertainty or inflation. You can own physical metals, or you can own funds that track their value. If you're considering precious metals, it's important to understand that they generally do not generate income. Gold doesn't pay dividends. Silver doesn't pay interest. Your return depends entirely on future price appreciation. And as many regulators have noted, investors should be cautious about high commissions and aggressive sales tactics. For most people, funds are usually a simpler option. Now let's talk about the asset class that receives more attention than almost any other: cryptocurrency. Cryptocurrency is a digital asset. Unlike stocks, it doesn't represent ownership in a business. Unlike bonds, it doesn't generate interest payments. And unlike real estate, it doesn't produce rental income. Its value depends largely on what buyers and sellers are willing to pay. Cryptocurrency has experienced periods of tremendous growth. It's also experienced periods of dramatic decline. Price swings of 50% or more are not uncommon. Because of that volatility, many financial professionals consider cryptocurrency highly speculative. If someone chooses to invest in cryptocurrency, it should generally represent only a small portion of their overall portfolio, and only money they can genuinely afford to lose. Finally, let's talk about collectibles. Things like art, wine, rare coins, sports memorabilia, trading cards, classic cars, and other unique items. These investments can sometimes increase significantly, but they also come with challenges. They produce no income. They may require storage and insurance. And finding a buyer at the right price can be difficult. Liquidity can be a major concern. Now let's step back and look at the bigger picture. Notice a pattern? Many alternative investments can be exciting. Some have produced extraordinary returns. Some may deserve a place in certain portfolios, but none of them eliminate the need for a strong investment foundation. The most successful investors don't usually build their wealth by chasing every new opportunity. They build their wealth by consistently following a sound plan. Then, if appropriate, they may add small amounts of alternative investments around the edges. Think of alternative investments as a supporting cast, not the star of the movie. The stars remain a disciplined savings habit, a diversified portfolio, a sensible asset allocation, low cost, long-term thinking, and patience. Now open your workbook and turn to the section called Alternative Asset Reflection. Review the different asset classes we discussed today and answer this question: are there any alternative investments I currently own or am considering? If so, what role do they play in my overall financial plan? Remember, curiosity is good, exploration is fine. Just don't let exciting investments distract you from the core strategy that builds long-term wealth. In the next lesson, we'll discuss something many investors overlook. Not what you invest in, but where you invest. Because the type of account you choose can have a major impact on taxes and long-term results. I'll see you in the next lesson.